The longest bull market run in history comes to an end because of a pandemic. Who would have thought? So, when I was doing my undergrad, the final year of my undergrad in economics, there were a lot of professors saying that this has been the longest and most prosperous bull run in human history, from June 2009 to February 2020. This length is unprecedented. There's usually much shorter cycles when it comes to boom and bust in the economy. And every country really felt the impact of this pandemic. So in the US, 9.1% fall in quarterly GDP in Q2 of last year, which is the largest and the steepest decline in GDP since record keeping began in the US. And in the UK as well, so consecutive quarters of GDP decline, which means that countries went to recession. Unemployment rate in the US was around 14% at one point around March 2020, if I remember, somewhere in that region, and then it came down. The job losses were staggering. I think 113 months of consecutive job growth came to an end because of the pandemic in the US, and the entire global economy suffered. The IMF expects the global economy to have contracted overall from between 3.1 and 3.5%. Overall, the global economy has suffered. Shops, restaurants, airlines, cruise companies, energy companies, banks, everyone took a hit because of this pandemic. Non-essential travel obviously couldn't happen, so the airlines were suffering. Restaurants, people stayed home, stay-at-home orders, banks, mortgage defaults, and trouble in collecting those payments. Although the trading arms of the banks did particularly well, the economy fundamentally has changed from what it was last year to now. E-commerce has rapidly grown as people are now shopping online more than ever because they can't even go to a physical retail store anymore. So around 120 million people contracted COVID-19, around 2.65 million deaths. This is staggering compared to sort of pandemics and other widespread diseases in the past in human history, but the closest comparable is around a century ago, the Spanish flu in 1918, where you had roughly 500 million, the CDC estimates, cases and 50 million deaths. So last year when COVID first came about, researchers at the University of Hong Kong and Harvard, they estimated that around 25% to 50% of the entire global population would actually contract COVID, which is staggering unless any mitigating measures were taken. And that's what governments did. That's what every government in the entire world pretty much did in terms of cancelling international travel, non-essential travel, having stay-at-home orders. Restaurants had to shut down, and the economic impact of these things was deadly and fatal for some businesses and for some people's livelihoods. But as you can see, not even close to 25% of the global population actually ended up contracting the virus. 25% of the global population would be around 2 billion people, but at the end it was 120 million people that contracted the virus. So these measures that the government took, not just legislative measures like stay at home, but also the massive amount of stimulus that the government put into the economy. I'm not going to go into whether this was economically sustainable to borrow this much money and stimulate the economy the way the governments did, and the inflationary implications of these things, whether it's economically good or bad, I'll let it be. But if this pandemic went completely unchecked, the consequences of it would have been far more dire. The CARES Act in the US, the Coronavirus Aid, Relief and Aid, Relief and Economic Security, I believe, Act, which was passed last year in March, had transferred around $1,200 per household in the form of a stimulus check. In December there was another stimulus check, and I think this month or last month there was another round of stimulus. And in the UK you see things like the furlough scheme. In pretty much every advanced economy and even developing markets, you're starting to see either some form of fiscal stimulus or monetary stimulus. In terms of your investments, this is the tricky one, so I encourage you just do your own research, but just as a sort of closing piece of advice, don't panic sell. If the markets crash, which they might, because asset prices rose last year quite a bit, stock prices rose, although the overall economy was really declining, asset prices didn't reflect this properly. So if stock prices fall, don't panic sell. If you looked at sort of 2008, the recession, the years following, the markets eventually did recover. And so having that long-term focus is something that I would always encourage. Without making impulsive decisions, always focus on the long term, and in the long term you will be able to recover your money if you've made sound investments in good companies and good asset classes. And the idea is that, you know, if you've invested in things that are good investments, that are well thought out, well researched, fundamentally valuable, you will recover your money eventually. So don't panic sell, don't make impulsive decisions. Well, that's all for today, guys. If you've enjoyed this video, do hit the like and subscribe button, and I'll see you in the next video.